Welcome back. In this lesson, we are going to look at perhaps the most important topic in the course, risk management. I cannot stress on this enough. A good understanding and implementation of risk management is extremely crucial to be a successful trader. So, what is risk management in trading? In simple terms, risk management is the amount of money you're willing to lose if the trade didn't go in your favor. It may be 1,000 rupees or 2,000 or 10,000, depending on your account size and the amount you're willing to lose when your stop loss hits. Professional traders are very conservative. We keep our risk constant and to a minimum in every trade. There are two components to risk management: risk to reward ratio and position sizing. If risk management was a coin, then risk to reward ratio is one side and position sizing would be the other side of the same coin. Alright, so let's discuss risk-reward ratio with the help of an example. Assume you have spotted a great trading opportunity. Let's say you have a buy signal for a particular stock at an entry price of Rs 150. And based on price action analysis, you think your stop loss should be at 145 and potential target is 160. Which means your risk is entry price minus stop loss, which is 150 minus 145, which is 5 rupees. And your reward is target minus entry, that is 160 minus 150, which is 10 rupees. Essentially, on a per share basis, you're risking 5 rupees in the market to make 10. So your risk reward in this case is 1:2. Potential profit is twice that of the risk. Let's look at another one. Buy entry at 150, stop loss is 145, thereby risk is 5 rupees per share and potential target is 165. So the reward is 15 rupees per share. Risk reward ratio in this case is 1:3. Now that we have learnt about risk reward ratio, let's understand position sizing, the other side of the coin. First thing is to know the size of your trading account. Let's assume you have 1 lakh rupees in your trading account. Next, you should define your risk on the trade, which is nothing but the amount you're okay to lose in the trade if it doesn't go your way. On any given trade, define the risk as a percentage of your trading account. Most professional traders risk 1 to 2% per trade. In this case, since you have 1 lakh in your trading account, with a risk tolerance of 1%, the risk per trade would be 1,000 rupees. The next step is to find the stop loss per share. From the previous example, we got a stop loss of 5 rupees per share. And now we can calculate the position size, which is nothing but the number of shares we can buy as per risk management rules. It's defined as risk in rupees divided by stop loss per share. If we are taking a risk of 1,000 rupees on this trade and the stop loss is 5 rupees, then we can buy 200 shares. And that is how we calculate the perfect position size. All these calculations may seem like a lengthy process right now, but in reality, it won't take more than a minute. It's pretty easy and straightforward once you start doing it before every trade. Now let's look at the kind of profits you will make given some common risk-reward ratios and win rates. Here's a random distribution of results when you take 20 trades with a risk-reward of 1:1, which means for every 1,000 rupees you risk, you make 1,000 if you win, or lose the 1,000 if you were to lose in the trade. With a 40% win ratio, out of 20 trades, 8 trades will be winners and 12 will be losers. Not a great P&L at the end of the month. A loss of 40,000. Next, with the same 1:1 risk-reward ratio, if your accuracy or win rate is 50%, you would have won half the trades and lost the other half. So theoretically, you are at break-even at the end of 20 trades. But if you were to consider the brokerage expenses and taxes, you would essentially be in a small loss. Now with a 1:1 ratio and 60% win rate, you would have won 12 trades and lost 8. And so you end up with a profit of 40,000. Clearly, with a 1:1 risk-reward ratio, you need a consistently high win rate to be profitable. And believe me, the best of the best traders have no more than 60% win rate, regardless of what they claim. Next, let's look at how you can improve your profitability significantly by taking trades with a risk-reward of 1:2. With a 40% win ratio, out of 20 trades, you won 8 trades and lost 12. But because these trades are with a 1:2 risk-reward ratio, you still ended up with a 40,000 profit. Isn't that awesome? It keeps getting better with higher win rates. If you had a 50% win rate, you win 10 and lose 10, and the profit would be about 1 lakh. A good trader would be someone with a consistent win rate of 50%. But if you were to have something like a 60% win rate, you would have made 1,60,000 at the end of the period. A 60% win rate is definitely possible with a sound understanding of price action, consistent results, and by tweaking your trade management. A 1:3 risk-reward ratio really makes your trading extremely stress-free, as even a small number of winning trades will quickly bring you to profitability. However, it's not very easy to get intraday trades with a 1:3 risk-reward ratio. You get such opportunities when the market is trending strongly in one direction. As you can see here, even a 40% win ratio gives you a profit of 1,20,000. And as you may have guessed, your profitability keeps increasing with higher win ratios. The important thing is to be very selective and taking only high probability trades which offer a good risk-reward ratio. To summarize, your stop loss can't be some personal favorite number. It should always be above the previous swing high or below the previous swing low. Never set a random stop loss. Stop loss 1% below the entry price for buying and 1% above the entry price for selling is very common in the intraday trading community. But that's gambling, not trading. Risk per trade should be kept constant for at least 1 month. If you're starting with 1 lakh rupees, for 1 whole month, the maximum risk you should take is no more than 1,000 rupees per trade. Remember, this is your learning period, and the lesser you lose by learning in a live trading environment, the better. As you consistently generate positive returns, you can gradually increase your risk based on the new account balance. Risk management is a make or break factor in a trader's career. It's the only thing that will make you profitable in the shortest period of time. You can be an average trader with no extraordinary trading skills. But if you're disciplined enough to apply good risk management, you will still be a profitable trader. I have been trading since 2010, and my average win ratio over the years is only 50 to 55%. However, I still end up being profitable because I have laid a strong trading foundation of sticking to good risk management rules. If you practice good trading habits, within no time they will be ingrained in you too. Thereby, your trading results will be very consistent.